All right, well, first of all, thank you for joining me, and thanks for having us. We're going to be talking about a millennium of mistakes and whether Bitcoin fixes this. So, is it a straw man to say gold failed? How would you guys explain this?
You should do it first.
All right. Well, I think on some level, before I was a Bitcoiner, I was a gold bug. I was crazy about, before I was an annoying Bitcoiner before I was a Bitcoiner, but my Bitcoin before Bitcoin was gold. So I used to always talk to people about gold, why gold is the future, why gold is hard money, sound money. All of the things that I say about Bitcoin, I used to say about gold. So back then, it would have been sacrilegious for me to say that gold has failed as money. Gold didn't fail as money, we failed it as money. However, after discovering Bitcoin, after becoming a Bitcoiner and figuring out why Bitcoin is better than gold, I think it becomes more, you can become more objective about it, and you look at gold and you can say, well, the fact that we failed in our ability to use gold, if you want to frame it that way, ultimately has to be a function of the failure of gold's property, of the inherent properties of gold that make it essentially unworkable as a form of money in the 20th century, because it failed to resist the government control and manipulation. And that's ultimately what it comes down to. So I like the fact that gold's supply increases at a low rate. I think gold is better money than pretty much everything that has ever existed except for Bitcoin. However, it does have this fatal flaw, which is that it's very difficult and expensive to move it around in a modern digital economy, which means that you have to resort to centralized services for moving it around, which means it becomes relatively easy for governments to confiscate it and to neuter its monetary role, issuing paper and credit that is supposedly backed by the Bitcoin, but then ends up not being backed by the Bitcoin and then eventually becomes inflationary fiat money. So by turning into fiat money, effectively, we could say that gold failed. And I think you become a Bitcoiner when you realize it's a lot easier to just build something that actually works out of the box than to try and convince the entire planet that we need to have the political and economic institutions that are geared toward a form of money that is no longer functional. It's very difficult to explain that to people. If you've tried to try and convince people to vote in order to bring back the gold standard, you'll realize, yep, this thing doesn't work anymore, because if it needs to rely on people voting, it's doomed.
Rahim, where are you at?
I'd say gold worked surprisingly well, but was made to fail. I'm not sure it's entirely, I agree that Bitcoin has the superior technical properties for monetary usage, but I don't think that's the reason the gold standard failed. And I think there's only one gold standard that really worked well, and it was the original one. And it's usually not the one we talk about and discuss. There were 5 gold standards, actually. The original one, I consider the one used by merchants and in a bottom-up discovery process discovered by merchants. And they discovered that gold is useful as a money because you cannot define an algorithmic money. They realized it's not the face on the coins that determines the purchasing power of that money, but you could have a standard that just defines the fineness of the gold and the weight of the gold. And that's a great way to go about a standard. And it's a similar standard that Bitcoin introduces. It's an algorithmic standard. It's not a top-down set standard by an authority, by an agreement, by a commission. It's not an organized standard. It's something you can discover and you can verify. And I think it was algorithmic in that sense. Now, that's not what we usually talk about when we see gold standard. We usually think about the classical gold standard that worked relatively well still, but of course had the issue of being a set standard. In the best case, it's an agreement, again, but that of course led to failure, because gold was never the only money and the only good with monetary use. Silver was of course a contender. Most day-to-day transactions were either paid in silver. And when you want to set that as a standard to define away volatility, that's exactly what broke the back of classical gold standards or monetary unions like the Latin Monetary Union, where they set a bimetal fixed bimetallic ratio between gold and silver. And of course, we know as Austrian economists, prices are never fixed. There's always volatility. In the case is vitality. let's say, so if you fix it top down, then of course you have it break somewhere and you set the wrong incentives. And that's exactly what happened with the classical gold standards. But it got much worse. And it was not through the failure of gold that it got much worse, I think. It's the gradual political process of centralization, trying to abuse anything and plunder anything. The next standard was actually the gold bullion standard, where you say for ease of using that standard, you can only get redemption in bullion, which of course is a lot of gold, and that of course takes it out of the hands of normal people. I mean, even gold coins were kind of upper middle class money because it has a lot of purchasing power, but a gold bullion is like only the richest would ever touch it.
Right.
And that was the step away, and of course there's a centralizing process. And then you have the gold exchange standard, which is setting ratios between currencies that are supposedly gold-backed and are on a gold bullion standard. So you have a few currencies that are on a gold bullion standard, and then you take those currencies as the kind of backing, and that was the gold exchange standard. And then, of course, the worst form, but still much better than today, was the Bretton Woods standard, where you basically have just the dollar as a gold exchange standard currency. And that, of course, made it very easy to go the last step. And it wasn't really for the fall of gold that the last step was taken. It could be in anything. And it, of course, could eventually happen to Bitcoin as well if it was centralized completely and there was like one paper Bitcoin available in the end, and one government decided to go that way eventually and not accept any redemption of Bitcoin or a different kind of Bitcoin and so on.
Well, yeah, thank you. That's a great overview, Rahim, on as the topic, the millennium of monetary mistakes. So obviously, as maxis, we like to say Bitcoin fixes this. So obvious steelman could be, well, can Bitcoin eventually centralize in the way that Bitcoin did, whether it's some kind of layer 2 that doesn't have the same full reserve assumptions built in? Now, of course, as maxis, we'll say, not your keys, not your coins. What is the worldview implied by that? Full reserve, generally. So can you gentlemen explain for us, the steelman case? Could Bitcoin centralize, and could we go back around full circle?
Yeah, I mean, if I were to make the case for it, I'd say ultimately there's a limit on how many on-chain transactions happen on Bitcoin. Currently, it's around maybe 500,000 transactions a day. So that's obviously nowhere near enough for the whole world to be using Bitcoin on-chain. So if everybody wants to buy their coffee and groceries and cars and homes on-chain, then there is enough space on the Bitcoin blockchain for one neighborhood in Abu Dhabi, maybe, one tiny part of Abu Dhabi, not even all of Abu Dhabi. So clearly you can't have all the transactions on-chain, which you would expect then necessarily is going to result to second layer solutions that are going to involve some level of centralization, which is going to repeat the process of gold. And therefore, Bitcoin will be centralized, and then you're going to see the same thing. Governments will issue Bitcoin-backed financial assets, money, say paper and credit, digital currencies that are backed by Bitcoin, but then they'll suspend redemption of Bitcoin, and then you can't get Bitcoin for it. However, I don't think that this is likely to happen with Bitcoin as it did happen with gold, because I think there's a key distinction between the two, which is the ease of transacting outside of second layer solutions. So it might look like it's not a lot, it's 500,000 transactions a day, but 500,000 transactions a day of final settlement transactions is actually a huge improvement over what gold can do. Because with gold, it's really expensive to move gold around, say, from Europe to China or from China to the US. It's extremely expensive. 1 bar of gold, which is, say, the 400 ounces of gold, it'll cost about 1% of the cost of that bar, maybe, to move it around, somewhere in the 1%. So you move the bar around 100 times around the world, and you've eaten the cost of the whole bar. So if you want to move $1 million of Bitcoin, of gold around, you're incurring significant fees every single time. And if you do it for 100 times or so, you will basically incur the entire cost of it. And it's time consuming because it takes a lot of time to move physical gold around. Now, if you compare that with Bitcoin currently, we have 500,000 transactions that you could do for a few cents per each transaction, and you have final settlement in about an hour. So this is really fundamentally the difference. If you think about how fiat came into existence, it came into existence in World War I when governments confiscated the gold, or they already were sitting on the gold, but they confiscated the gold that was in their central banks, and they took the gold from the banks, and then they told people you can only use the paper to make payments, and you can only use credit to make payments, and you cannot use gold payments directly. You can't trade with the rest of the world with gold. That was really the key thing. International trade in gold was stopped in 1914, and you had no alternative. If you were a French, German, British person, Russian person at that time, you couldn't have opted out and said, all right, well, they don't want me to use gold. They want me to use their paper money, but I'm going to opt out. I'm going to trade with my Russian trade partner using physical gold directly. How are you going to do it? Well, one way to do it, small little advertisement. In my book, my new book, my latest book, The Gold Standard, I imagine what would have happened if that was possible. If you did have a possibility for people to trade outside of central banks using airplanes, and so I develop an elaborate story that you can check out and you can get the book. But in the real world, we didn't have that. In the real world, once the government said you can't use gold, you have to use our paper, everybody in France and Germany and Britain and the US had to abide by that. There was no form of gold trading outside of that. Well, with Bitcoin, even if governments centralize Bitcoin reserves, even if they issue financial assets that are partially backed by Bitcoin, you are still able to go on the Bitcoin blockchain and make a $1 billion worth of transaction across the world for a very cheap fee. And granted, I think the fees are going to go up over time, but they could go up 1,000-fold and still be cheaper than what it costs to move large quantities of gold around the world, which is what you would need to do to have a decentralized form of gold standard. So fundamentally, for me, the decentralized nature of Bitcoin, the fact that Bitcoin mining is open, that nobody can stop you from mining Bitcoin, anybody can build a Bitcoin mining facility, anybody can process transactions, and anybody can put transactions on a block, and the fact that it's so easy to obtain the technical requirements necessary to run a Bitcoin node or to send a Bitcoin transaction. There are billions of devices around the world that are able to do this. All you need is just one of them and an internet connection, and then you're able to buy and sell Bitcoin. The cost of getting into Bitcoin, if you're banned by the government or if you're stopped by the government, is incomparably lower to the cost in the case of gold, which in my mind means that it is practically impossible is a big word, but it's very difficult for governments to be able to stop you from using Bitcoin if they don't want you to, which means that if they do introduce any kind of inflation or any kind of solution that compromises the properties of Bitcoin, they are powerless to stop people from leaving their platform. So therefore, with gold, they can tell you, well, you have to use our paper, it's no longer backed by gold, and that's it. And if you don't like it, cry about it. But at the end of the day, if you want to trade with somebody in any place other than our country, you need to use our central bank. With Bitcoin, they cannot do that. And the fact that they cannot do that means that people have a fallback option. And that means that we don't need to have every single person do every single transaction on chain. What matters is that we can fall back on chain if we suspect something not good happening in any of our second layer solutions. And the fact that we have the threat of exit is what keeps, in my mind, is what keeps business service providers, Bitcoin service providers in business, is what keeps them honest, what keeps them afraid of essentially messing with your Bitcoin. Because if you suspect that they're messing with your Bitcoin, that they're not backing their financial assets with Bitcoin, you will leave. And in a Bitcoin world, I would imagine you would see bank runs happen very quickly because people can detect on-chain the movements of money in and out, and they'll be able to establish if a company is insolvent a lot faster than you can with the fiat monetary system, which is very corrupt and very liable to manipulation.
Yeah, so go on,
Yeah,
Rahim.
let me just where I potentially disagree, because there's a lot of agreement. Now, the bit steelman gold again, historically, the solution the merchants found for the big transportation cost was to just settle in the fair towns. So that's a kind of layer 2 solution. And it wasn't exactly that layer 2 solution that centralized. And I think Bitcoin is there even superior, and we already have the layer 2 solutions. I don't think Lightning or Cashew within themselves have the risk of centralization. Of course, there's a trust trade-off, as the merchants have in their settlement systems back then. But as long as they are voluntary, then of course everyone can assess that trust situation and could react to any change of that. It would only become dangerous if we have a regulatory step towards cartelization. If one day, like the cashew mints, because there's so much usage, would form a cartel and you need to get a permit to become a cashew mint, and those mints of course use that cartel privilege to enrich themselves, either by fractional banking or by not even having any backing because they declare, oh, we don't really need that Bitcoin stored, you can trust us, kind of thing. And then, of course, there is a similar risk with Bitcoin. If regulation would become more monopolistic in the future, which fortunately the geopolitical tendency at the moment seems to rather go towards a multipolar order. But if this kind of centralized oversight and control of finance would still like increase its power of the people, and more people would in their trade-off say, oh, I need the trade finance access, I need to use a broker because that's how I work, then of course we could see the same risk, and we see that today, even though Bitcoin settles for very little money 24/7, Bitcoin in the banking world, or if you use a brokerage in between, it may sometimes take weeks because it's like, oh, it's Sunday, the compliance officer is not at work, we can't process that payment right now, you got to wait, and it gets much more costly, of course. You may say, well, you're not actually settling in Bitcoin, but some actually give you the illusion of using Bitcoin wallets, but they have to pass through a regulatory
Like
screen.
a custodial KYC compliance.
Exactly. So if that direction would be similar to what we've seen in history of gold, that of course could eventually be a risk for Bitcoin. So I think it's important to be aware that Bitcoin doesn't solve that general problem of if there is a more concentration of regulatory power. And I think the main hope we have is more decentralization, and Bitcoin should help with that, and hopefully it helps with that, but it doesn't fix it entirely. We need to work for more competitive jurisdictions, more jurisdictions, smaller jurisdictions, to allow Bitcoin to have its full leverage for liberty.
I see, yeah. And so let me summarize some of that. So as Saifedean was pointing out, there's 500,000 transactions per day. And to be clear, even that, you can have a batch exit. So let's say one exchange does a withdrawal to 100 customers, and that's still one on-chain transaction, as an example. Now, of course, still limited by block space, but the broad point is we have these L2s. Some of them are very open entry. Anyone can set up a Lightning node if you wish. Of course, there are other L2s now, things like Arc, Spark, if you count Liquid and Cashew, and even other things that aren't invented yet. We have all these ways that people can still transact on higher layers without even having to hit the chain each time, at least. You can compress some of that off-chain. And then, as you were saying, Rahim, there's a risk around, let's say, KYC regulation compliance that maybe blocks people if they need to go to Fiat. Now, we've got about 7 minutes left. I think we've got time for one more topic, which I think we will find interesting. Let's say we're Bitcoiners, we're maxis, we're right about this, number is going up. In 20 years' time, it's going to be like $10 million per coin. What happens in such a world? Will people just directly transact in small fractions of a Bitcoin or in Satoshis? Or will there be some kind of fiat coin on top of that it's like hodl the Bitcoin and spend the fiat? Or is it, no, actually, we're going to live in the hyper-Bitcoinized world and we'll spend very small fractions of a Bitcoin? What do you guys think?
If you ask me, I think monetary competition is a winner-take-all process. And so nobody wants to be using the second best money. Network goods centralized towards a winner-take-all dynamic, and money is a network good. So everybody would want to have the money that is the most liquid. This is one force toward one winner-take-all. And then the second one, which is the one that I discuss in more detail in my work, is the fact that the best money holds onto its value better. So it accumulates value while the worst monies will lose value. So even if you would say that people just want to use the crappier money, people like it, people are used to it because of traditions, doesn't matter. People like to use seashells as money, people like to use glass beads as money, people like to use all kinds of archaic little things as money. And it wasn't because somebody organized a campaign to market gold to them that they eventually dumped all of these shitcoins for gold. It wasn't because somebody forced them. It was because of economic incentive. It was the force of economic incentive that compels people to behave in that way. And it compels them simply by making it so that if you don't behave in that way, you don't have any more money. If you put your money in seashells, you don't have money. All the money will end up in gold, whether people like gold or not, whether they like their seashells or not. Your options are get into gold and keep your money, stay in seashells and lose all of your money. So I think this dynamic is likely to continue. And I don't see it stopping because I see Bitcoin's scarcity continuing to be better than everything else. It continues to increase at a lower supply growth rate. So everything else becomes more abundant. Everything else becomes less and less valuable in Bitcoin terms. And people who use other forms of money end up losing more and more of their wealth. So naturally, wealth will concentrate in the hardest money. And naturally, people will want to get paid in the hardest money. So in my mind, I think, it may take a while. People's government indoctrination may keep them tethered to their government coins for a while, but ultimately there's no defeating the force of economic incentive. Government money is going to continue to lose value. Bitcoin is going to appreciate in value. And so at a certain point, I believe governments are going to have a choice to make. Would you want to witness your currency continue to die and fade into irrelevance? Or would you prefer to peg your currency to Bitcoin? So we may continue to be using things like the dollars and the dirhams and the euros and the yens and the yuans, but these things will have to be denominated in Bitcoin because otherwise they will continue to lose value against Bitcoin and nobody will want to use them or accept them. And so in this situation, I would imagine we'd have them backed by Bitcoin, which means they would be redeemable in Bitcoin. And I believe with Bitcoin, as I was saying earlier, there's a lot less room for error. So there's a lot less room for governments to be engaging in inflation when they're using Bitcoin because people don't need to use them. They can use all kinds of other solutions. So ultimately, I think Lightning has enormous potential. And I still think Lightning is still the most exciting thing happening in Bitcoin. I think you can scale Lightning enormously because you can have small little nodes that only serve a few hundred people. And you can have millions of these that grow over the next few years. And that would produce a very decentralized ecosystem of tens of thousands or millions of Bitcoin nodes, none of whom can control the monetary policy, and none of whom can fake transactions on the Bitcoin blockchain. So none of them can really manipulate the chain. All they can do is just serve customers and get a return for it. And I think that's going to be a very healthy ecosystem that's going to lead to a competitive equilibrium where people are constantly providing the service of payment clearance in a centralized way, but a much more decentralized way than Bitcoin, than gold or fiat.
I agree, there are very strong network effects for a settlement layer. I disagree. I think it will never be the case that Bitcoin will be 100% of the money supply. Even in today's measures, which I think should have been expanded to look at wealth in general, we see there are very different preferences concerning volatility and risk. And of course, we'll have other wealth asset shares represent assets. We'll have claims representing assets with different maturities. We'll have trade finance. So I think this layered structure overall holds, and for different preferences of people and different contexts, it may all be hopefully Bitcoin layered things, but I think, of course, a Bitcoin world will not be a utopian perfect world where everyone has like the lowest possible time preference and everyone can be trusted 100%. There'll still be tricksters and fraudsters. There'll be business models that afterwards look like scams, but beforehand you couldn't say it, like it could have worked out as a kind of premise thing. And I think market economy is always a discovery process, and buyer beware. So I think, of course, there'll be experiments, and with some experience may lead to discovery, yeah, that people actually have different trade-offs and different timelines and perspectives, and some would like lower volatility instruments that hopefully have some Bitcoin relation and Bitcoin backing, but may even use derivatives, may even be credit claims where you have to assess collaterals and how risky are different collaterals and what's the maturity of financing. So I think we still have that, and I think we still need that at least in part.
Interesting. So I get we don't have a lot of time for discussion, but I guess I'm summarizing then. Saif's view is more like it's going to be either just Bitcoin, Bitcoin denominated, and Bitcoin denominated
Financial
say,
instruments.
Yeah, pegged. You know, that governments will just peg to Bitcoin because they'll just sort of throw in the towel. And I guess Rahim, your view is maybe a little more like there may be a role for other kinds of denominated assets because of things like trade demands. Yeah, but I guess we'll have to. But I think we all agree that number is going up, and Bitcoin is going to fix this. So I think that's all we have time for. So everybody, please put your hands together for Saif and
Thank you.
Rahim.
Thank you, everyone.